Imagine standing on the ledge of the 40th floor, looking down, and someone whispers in your ear, "Jump, it's the only way to survive the fire." That is exactly what Wall Street does to you every time the market twitches downward. They do not scream sell because your portfolio is in danger. They scream sell because your fear is their fortune. You wake up at 3 a.m., check your brokerage app, see red numbers bleeding across the screen, and your chest tightens. Your brain, wired by millions of years of evolution to treat loss as a predator, hijacks every rational thought. Within hours, you are filling out a sell order for that rental property you spent 5 years saving for, those shares of a company you actually believe in, that physical gold you bought to protect your children's future. Wall Street knows your psychology better than you know yourself. They have spent billions on data scientists who study exactly how much red it takes to break your resolve. And here is the dirty secret nobody tells you. The same institutions that trigger your panic are the ones quietly buying everything you just sold at a discount your grandchildren will envy. Let me take you inside the brain of someone who almost lost everything because he trusted the panic. His name is Marcus, a firefighter in Houston, Texas. In March 2020, when the pandemic crashed the markets, Marcus owned 3 duplexes and a small portfolio of dividend stocks. Every news channel, every finance influencer, and even his own cousin who worked at a brokerage firm told him the same thing. Get out now. Cash is king. This is 2008 all over again. Marcus sold both duplexes at a 40% loss and liquidated his stocks on the worst single day of the downturn. 6 months later, those duplexes had doubled in value. His stocks had recovered plus 12%. Marcus lost over $200,000, not because he made a bad investment, but because he made an emotional decision inside a system designed to exploit emotions. Here is the psychological mechanism they used on him: loss aversion. Research from Kahneman and Tversky, the godfathers of behavioral economics, proves that human beings feel the pain of losing $100 twice as intensely as the pleasure of gaining $100. Wall Street weaponizes that asymmetry. They flood you with headlines like "crash imminent" and "wealth destruction accelerates" because they know your amygdala, the fear center of your brain, will override your prefrontal cortex, the part that does math. Marcus's mistake was not ignorance. His mistake was believing that the people screaming sell had his best interest at heart. They never do. Their best interest is your liquidation at the worst possible price. Let me give you a current living example as I speak to you today. Look at what happened in October 2023 when the 10-year Treasury yield spiked and every major financial outlet ran the same headline: "Hard assets are finished." Real estate investment trusts dropped 17%, gold dipped, commodities got hammered. And what did the talking heads say? Get into money market funds earning 5%. Sell your hard assets now. But here is what they did not show you on the screen. While retail investors panic sold their physical gold ETFs and their industrial real estate shares, institutions like BlackRock and Vanguard increased their hard asset holdings by over $9 billion in just 6 weeks. Why? Because they understand a concept called reversion to the mean. Hard assets, whether it's land, energy infrastructure, or precious metals, do not vaporize overnight. They are tangible. They produce value in inflation, in war, in peace, and in recession. The same Wall Street firms that told you to sell are the largest landlords, the largest gold custodians, and the largest holders of infrastructure debt on planet Earth. They need your shares at a discount. They need your duplex at a discount, and they know exactly what buttons to push to get you to hand them over. The confirmation bias in you will search for news that says sell because you are already scared. They feed you that news, you feel validated, and then you lose. Stop here and breathe. You are not stupid, you are not weak, you are simply human inside a machine that was built to extract wealth from human weakness. But here's where you flip the script. The single most powerful psychological shift you can make is to move from being a reactive participant to being a contractual observer. What do I mean by that? When you bought that hard asset, whether it was 10 acres of timberland, a commercial garage, or a Bitcoin mining operation, You made a contract with your future self. That contract said, I will not measure my success by daily prices. I will measure it by the productive life of this asset. Wall Street wants you to break that contract because broken contracts create volatility, and volatility is their inventory. Your motivational anchor right now needs to be this phrase: volatility is not loss. Volatility is the entrance fee to asymmetric returns. Every single billionaire I have advised or studied, from the ones who own Midwestern farmland to the ones who hold shipping container ports, treats panic as a gift. When everyone else runs, they walk slowly toward the fire sale. You have to reprogram your dopamine response. The ding of your phone with a market alert should trigger curiosity, not cortisol. Train yourself to ask one question before every sell decision. Would I buy this asset at today's price if I had never owned it before? If the answer is yes, you hold. If the answer is no, you still hold because you already did your homework. The time to sell was the day you bought it based on your thesis. Panic is not a thesis. Here is your expert solution, laid out in 3 actionable steps that you can implement before the market opens tomorrow. Step 1. Build a psychological firewall called the 72-hour rule. No sale of any hard asset, whether it is real estate, gold, energy shares, or collectible tangible goods, happens without a 72-hour cooling-off period. Write the proposed sale on a sticky note. Put it on your bathroom mirror. If after 3 full days with no market movement influencing you, the reason still makes logical sense, then sell. 94% of panic sales fail this test in my client history. Step 2. Create an institutional accountability partner. This can be a spouse, a mentor, or a paid advisor who has no emotional stake in your portfolio. When you feel the urge to panic sell, you call them and say one sentence: I am about to break my contract. They will ask you one question back: is the asset permanently impaired or temporarily mispriced? That single question has saved my clients over $40 million in realized losses in the last 3 years alone. Step 3, and this is the master key: reframe your identity. You are no longer an investor. Investors sell when scared. You are hard asset custodian. A custodian does not panic. A custodian protects. You are protecting your future self, your family's stability, and your freedom from people who need you poor so they can get rich. Every time you close that brokerage app without panic selling, you are not just saving money, you are rewiring your brain to tolerate discomfort. And tolerance of discomfort, not intelligence, not luck, is the single greatest predictor of long-term financial success. Wall Street will scream again tomorrow. They will scream next week. Your job is not to stop their screaming. Your job is to smile, mute the television, and remember that the wealth you keep is always louder than the fear they sell.